In industries like investment banking, venture capital, or private equity, understanding numbers is very important, but understanding the deal terms is what is going to make an analyst a real deal maker. In part 1 of this entire series, we covered what actually term sheet is, how is it created, who is going to draft it, and we also covered how transaction details are structured. In this video, we are going to cover the most critical section of the entire term sheet, which is key consideration. In this section, important clauses like downside protection, control rights, and exit mechanisms are defined. After this section, we'll also look into documentation mechanics and some general clauses that makes this document legally enforceable. As like part 1, this video is also going to be long, and if you are genuinely interested in cracking into these deal making rules, then only continue with this video. I leave the like, comment, and subscription in your hand, but the only thing that we want from you is your undivided attention. Hey there, my name is Karan Damania. I am an ex-investment banker turned founder, and through Encoding Careers, we help you break into investment banking the right way. So let's now get onto the screen and start understanding the further details of the term sheet. These are the 3 core sections that we are going to cover. The section number 2 is key consideration, where we are going to understand how power and economics are decided. Section number 3 is going to be documentation and incidental matters, which helps us understand how deal actually closes. And finally, some general clauses for legal hygiene and enforceability. These are going to be sections where most negotiation happens. So in this video also, we are going to take a look at this particular template which we used in part 1, and with every clause that we cover, we are going to look into the template as to how it is presented legally. Starting with section number 2, which is key consideration, we have clause number 1, that is liquidation preference. In this document, there are some of the clauses that are divided into 1 or 2 parts, and we have not covered. So if we'll take a look, there are around 14 odd clauses that are there in this section 2, but we have clubbed them and we have covered 7, which takes care of most of the important ones. Clause number 2.1 is liquidation preference, which helps us understand who gets paid first when things go wrong. So in the previous video, we covered the instruments that are going to be used for this particular transaction, and the instruments that can be used are mostly equity, preference shares, or convertible debentures if the investment is made on the side of equity. If it is debt, then there are different elements like debentures, bonds that can be used in case the investment that is put by investors does not fare out well and the business suffers, and it comes at the edge where they now don't have the capacity to run more going down the line. Then if the company is going to sell out the entire business, who gets paid first? That is what is decided in this liquidation preference. So here it defines payout order during exit, liquidation, or sale. It usually favors investors over common shareholders because investors are taking risk and putting money into the business on the equity side, because the principal amount that they are putting into the business, there is no definitive term mentioning that that principal has to be returned. So in case when things go wrong, they should understand that their money is going to be safe, and the amount that can be paid back to the investors in case of this liquidation could be 1x participating or non-participating. So talking about participating and non-participating, these are mostly used when product that is used for this investment is related to CCPS or CCDS. They have certain element of returns over and above the investment amount. So talking about preference share, it could be 20% preference share, it could be 15% debentures. These are kind of dividends that are paid from the profits that the business generates to the investors. So participating is where fixed amount is paid and over and above the profit share is also paid, and not participating does not get the profit share part. There are a lot of resources that cover about this participating and not participating, so you can definitely check out if you want to understand in more detail. So this helps protect the downside risk for investors. The most important thing that investors want when they are putting money into any business is that there should be less risk into it, and through these clauses that is definitely covered. So let's look into the template that we have over here. So the clause number 2.1 that we have covered is 2.11 over here, and it mentions that subject to applicable law, the holders of equity share have preference over other equity shareholders to distribute the company from the third parties upon the occurrence of liquidation event. So liquidation event has to be described in definitive documents as to what is it exactly going to be. So if the company is not able to maintain profitability for the next year, then they are going to go for a liquidation event. Or if the company burns the amount that is raised in less period than the amount defined and they are not able to run the operations of the business. So all of those things have to be mentioned in when the occurrence of liquidation may happen. And then it is mentioned how will the amount be received by them. So it could be pro rata share of investor shareholding converted a basis but unpaid dividends. So if there are unpaid dividends, that might not be taken into account. The investment amount plus all declared but unpaid dividends, whichever is higher. So in the final document, that this would be mentioned in detail with detailed amounts taking into consideration how much investment is made, because based based on that the dividends can be calculated, right? That is about the clause number 2.1, liquidation preference. Next clause is anti-dilution protection. So here in clause number 2.2 we get to understand what happens if future rounds are at lower valuation. In the first part of the video we took an example that our company is going for a venture capital funding round, and the valuation that we are looking to raise the amount is 50 crore pre-money, and we are raising 25 crores, so the valuation post money becomes 75 crores. Clause number 2.2 helps us understand if the next round from this particular round takes place below 75 crores, then what happens in that scenario. So it protects investors from value erosion. So there are some things that are mentioned over here that will help the current investors protect the investment that are made at 75 crores. It adjusts the conversion prices of their share. Common types are full ratchet and weighted average. So this is very critical in early stage deals because these early stage sectors work in very cyclical manner. If AI deals are taking place a lot, so there might be very hyped up valuation in this AI sector for early stage deals. So if a company gets value around 30 million today, the next round might happen when the cycle is not there and the valuation might drop to 10 million. That is kind of risk that the investors take when they invest in the cyclical sectors. Let's look at the template and we will understand in more detail. This is clause number 2.3 in our document. So if any time after closing the company issue third party equity shares at a price that is lower than the price paid for equity shares, then the investors will be entitled to anti-dilution protection on broad-based weighted average basis. So there might be weighted average basis or it would be full ratchet. Now here it is mentioned in weighted average basis. That means for an example, if the investor invested in this AI company at $10 per share, and now the next round of valuation is taking place at $5 per share. So investors that invested at $10 convert all of their shares, 10 plus 5 divided by 2, that is around $7.5. So that way their risk is now protected and they are not having as much risk as entire $10 value. In case of full ratchet, which we have over here, this gives investors the maximum protection. It means that the investors can now convert the entire shares that they have at $10 directly at $5. This will give them additional shares at a lower than $5 value, and overall their shares will become at $5 value. This is the benefit of having full ratchet. Very risky for the promoters because then they are the ones who will have to dilute more. So sometimes through this full ratchet, the promoters might even lose their control over the company because they might have diluted so many shares. It's very mathematical. So when you are doing live deals, you will understand this in more detail when there are a lot of numbers that are put out. Currently, since we are understanding the clauses, the main aim for us is to give you the understanding as to how these clauses work when you are doing a live deal. So that is about clause number 2.2. Which is anti-dilution protection, which takes care of the investors. The third clause that we have is board composition and control rights. This helps us understand who controls the strategic decisions that are taken into the business. So here the number of board seats for investors versus the promoters are discussed, the observer rights for investors, the matters requiring investor consent. This is very important because the control over companies operation matters more than the ownership. When they are talking in this particular clause, if they mention that if there is any control right related to operation, that if you want to onboard any vendor, then you have to reach out to us. We are aligned of whom you are onboarding as vendors and suppliers. So if that kind of operational things have control of the investors, then it is very stressful for the promoters to manage the company. So in the term sheet we have that as clause number 2.1 itself, board composition and incidental matters, where the rights of the board is decided from the investors, how many people are going to sit on the board. So the investors shall be entitled to nominate one person as the observer of proceeding of the boards. So this is also defined in more detail in the definitive documents when things are going to be finalized as to what rights have to be given to them. Since here the incidental matters are not covered in the further clauses, definitely there are some of the matters which will need investors approval. We are going to look into those, and this clause over here gives understanding that how many people from the investors are going to sit on the board and they will be making decisions for the company. So that is clause number 2.3. 2.4 is reserve matters and affirmative rights. So here some decisions that cannot be taken unilaterally. This is what we talked about in clause 2.3, that if you want to take some decisions, then you will have to take approval from the investors that are putting money in this particular round. These are decisions like issuing new shares, raising debt, doing M&A or any particular asset sale of the business, or changing the business model. In our part 1 video, we saw in the first clause itself, that when business is defined, the investors are going to mention that they are giving money for that particular purpose only. So we took our example that we are in education business, and if we are raising money, then we will have to spend it for the education operation part only. We cannot spend it on any other business line. Like if we have our investment banking business line, then we cannot spend it on that. So this ensures that investors have a say in major concerns. So if this clause would not be there into the picture, the company might go on raising a lot of debt. It might become impossible to cater the interest that the business then have to pay to cater to this debt. So that might be very problematic to the investors, because now the company might be trapped in this operational interest serving thing, and they might not be able to make profits, and the investors might not get value out of this business. All of these decisions have to be taken into account when both the party agree to it. Coming back to the template that we have, so when we covered this clause number 2.3, here control rights were mentioned, and that is covered over here in preemptive rights, and this mentions how many rights will be given to the investors when they invest into the company. So that takes care of clause 2.1 and 2.2 over here. We are looking into reserved matters and affirmative rights. So here we have affirmative voting rights. The company and shareholders shall not be permitted to take any decisions on certain matters without such matters having first received approval of investor director at board meeting. So the director that is sitting on the board of the company invested into the business, which is covered in the clause number 1 over here, they have to agree to the point that you can go ahead with this decision and take particular action. That is about clause number 2.4. Next we have clause number 2.5, that is transfer restriction. Here details are covered for who can sell shares and to whom. Now that investors have put in money into your business, or any acquirer has come in and acquired your business, they want assurity that the promoters who are running the business are not going to run away, and they will be staying into the company for a good amount of time. So that is where lock-in period for promoters is given. It mentions that the promoters are going to have the shareholding percentage what is there post the investment, but it is not going to be unlocked from the start. So there is a lock-in period. We will understand more in detail when we go to the template. Then there is restriction on share transfer. They cannot easily transfer their shares to anyone. There is approval for new shareholders. So that we saw earlier, that if they want to raise new funding, then definitely they will have to take the permission of the investors. So this prevents unwanted parties from entering cap table, and investors want to make sure that the cap table looks good, and when they want to go ahead and do other rounds, they get easy exits, seeing that the cap table is having good people on board. Coming to the template, here we are going to see the promoters and non-selling investor rights of first offer. Alongside that, promoter locking is covered, and vesting of promoter share. These are some of the things that are covered in this transfer restriction. So promoters lock-in mentions that the promoter shall not be entitled to transfer any person the share held by them in the company for a period of 3 years from the date of closing. The promoters may, however, transfer their shares to any person during the lock-in period, subject to prior written approvals of the investors and right of first refusal and tag along as set forth in clause number. So we are going to look at this right of first refusal and tag along rights going ahead. For 3-year period, the promoters cannot sell directly or indirectly to anyone the shares that they have. Even if they need money, they are not directly allowed to. If they are in very much need of that, they can get a written consent from the investors, and they might sell their stake. So in this 3-year period, 25% of the promoter shares shall be deemed to have vested on date hereof. The remaining 75% shares held by promoters will be restricted over a 4-year period starting from date of closing. From the completion of year 1, the unvested share will be vested in equal installment every 3 months. So every quarter, so every year you are going to get 25% of this unvested shares. This is a lock-in, right? You have to stay in the company for the next 3 years. So for staying in the company for the next 3 years, only 25% of your shares are unlocked as of now, and 75% will unlock in the next 3 years. So every year you will get 25% share. From this 25% also, you are going to get 4 quarter wise basis, as it is written over here. Every 3 months you are going to unlock. So 25 divided by 4, we get 6.25 is going to be unlocking every quarter from the next year. It is hereby classified that first quarterly vesting shall occur end of the 15th month. That is, after 15 months, the first unlocking of 6.25% will occur. So the manner of disposal of the unvested share can be customized. So this might be 6 months. The percentage of unvesting can be lower. 50% can be given to the promoters on day 1, 50% over the next 3 years. So that it totally depends upon how things are negotiated. The investor right of first refusal is clause 2.7. So subject to promoters lock-in as set forth in clause 2.4 of this term sheet. In the event of promoters or any shareholders other than the investor selling intends to sell all or part of their shareholding, the right of first refusal in the company, clause number 2.7 mentions over here that if the promoters or any other outside shareholder want to sell their shares, the investors that are there in the company, they have the right to buy all those shares at the same price that are offered to other investors. So that is the meaning of investors right of first refusal. If they want to increase their shareholding in a particular company, then the shareholders who want to sell to outside people, they will first have to reach out to these particular investors that we are selling these shares, are you willing to buy it? If not, then they will be allowed to sell to the outside person. So that is the meaning of right of first refusal, and the first refusal right is in the hand of investors. Alongside this first refusal, which is benefit for investors, there is also benefit for promoters, which is non-selling investors right of first offer. So when investor wants to sell out their shares to any party outside the company, they will first have to offer those shares to the promoters. If the promoters refuse, then they will be allowed to sell those shares to the outside party, which is covered in this clause 2.6. These are both covered in clause 2.5, which is transfer restriction, which helps us understand what is the restriction on shares transfer and who can sell shares and to whom. That takes care of clause 2.5. Next we have exit right, which is also very important clause and helps us understand how does investor get liquidity. So the terms that are covered over here indicate how the investor is going to get exit from the company. So it can include IPO, strategic sale, secondary sale, or a buyback option that the investors have. So since investors are putting money today, they want to get returns from the money that is being invested. For that, they need to understand, like, after particular point of time, how are we going to get back our money? So is the company going to go for an IPO? Are they planning to sell to a bigger company? Or are they planning to sell out a particular stake to other investors? Or are the promoters thinking to buy back the shares from the investor itself? So exit visibility is very key for private equity or venture capital funds, because they don't invest their own money. They have other investors who have given money to them, and that investors need return. Coming back to the template, here we have covered clause 2.1, 2.2, 2.3 is also covered, 2.4, 5, we have covered 6, 7. Tag along right is definitely going to be there down the line. We are covering exit mechanism, which is clause number 2.13. So the company and the promoters shall make all responsible endeavors to provide exit to the investors by the way of number A, which is initial public offering, which is an IPO of the company at a mutually agreed minimum valuation within 5 years from date of closing. So the valuation will be decided and will be mentioned in the definitive agreement. Option B, here they have mentioned or, right? So it could be A, it could be B, which is strategic sale of the equity shares at a price acceptable to investors within 6 years from the date of closing, provided the company and promoters fail to facilitate an exit under the clause 2.1.31a. So if they fail to do an IPO in 5-year period, then at the end of the 6th year, they will have to do a strategic sale of equity at an acceptable price to the investors. So strategic sale of the equity is going to be selling the stake to any acquirer who is bigger in size, and that is where the investors will be able to sell out that share to the new acquirer that is coming in, going to be at the acceptable price to the investors. So this could be A or B, and then there is drag along option. In the event company and promoters fail to provide exit to investors in accordance with clause 2.131, they have to follow this 2.132, where it mentions about drag along options. So we are going to cover drag along separate along with tag along. So here from the exit option, we got to understand about IPO and strategic sale. Term sheet might also mention that in case IPO does not take place, then the promoters are going to buy back the shares from the investors at an agreeable price depending upon the circumstances that the company is in. So that way the exit rights are given so that investors have a confidence that the company is going to make money for us. And finally, there are drag along and tag along rights, which are also very important. This helps us understand what happens if someone wants to sell. There are two parties that can sell their stake, right? One could be promoters, one could be investors. Drag along focuses on majority forces minority to sell, and tag along mentions minority joins majority sale, and it balances founder and investors interest. So now coming back to the template that we have, since exit mechanism was to go for an IPO or a strategic sale, if both of these fail, then in accordance with clause 2.132, the investor shall have a unilateral right to sell the investor's instrument to any third party, and right to drag along the promoters, requiring the promoter to sell whole of part of their shares if required by such third party to enable exit to the investors. Detailed provision will be given in the definitive document. So understanding with the example that we have taken, so if investors come and they invest into our company and they invested at 75 crore valuation, going 5 years, 6 years down the line, we did not go for an IPO, we did not do a strategic sale. So then the investors have an option of selling the stake that they hold. So they held around 33.33 percentage in the company. Now they can sell this 33.33 percentage to any investors that they find who is ready to put money into our company. And if that investors are saying that we will only take your investment if we get around 51% of the business, right? If they are acquirer, they want control over the business. So then the investor will have a drag along option that they can tell the promoters of the business that you will have to give out your around 18 percentage of the company to make this sale possible, right? So that way the investor will get 51 percentage of the company, the investors 33 percentage is going to get sold out, they will get money into their bank account, and the 18 percentage which is taken over by the acquirer will give money into the bank account of promoters. So that way they have the right to get this sale exit done. Alongside that, we have tag along, which we did not cover earlier. So tag along is something that is subject to promoters locking in the clause 2.4 of the term sheet. So tag along in simple language helps us understand that minority joins majority sale. If the majority shareholders of the company are selling out their share to a acquirer, then the minority can tag along. So in this case, as a promoter, we have 67.7 percentage in our example. If we are going to sell this 67 percentage sale to any particular company, then the minority, which are the investors, can tag along with us and sell their shares as well. So that is the right that they have in the tag along. And in drag along, we already saw that they can drag minority shareholders when they want to sell out their shares. In tag along option, the majority shareholders benefit, and in tag along, the minority shareholders benefit. So the final clause that we have is information and inspection rights, which gives investors right to the information that the company should share. So here the financial statement, budgets and forecast, audit and inspection access should be given to the investors so that it builds transparency and the investors have confidence that the business can grow. When this clause is mentioned in the term sheet, it allows the investors to understand that the promoters are willing to give out their information to us, and that will maintain the transparency, which is beneficial for both to take the relationship ahead. Coming back to the template, here we have clause 2.12, which mentions on the information right. As long as the investors hold any shares, investors shall receive the quarterly financial statement within 30 days from preceding quarter, audited financial statement within 60 days, and operating business plan within 30 days prior to commencement of following year. So all of this has to be given. This might change depending upon what is the exact requirement of the investors. So that way section number 2 gets completed of the term sheet. Here we have covered majority of the clauses via the presentation. Ones that are not covered in PPT are ESOPs. ESOPs have to be mentioned over here. How much percentage are we going to keep for employees that are going to join the company after this entire transaction goes through. Final clause was about free transferability. Here free transferability mentions that if investors want to transfer the complete ownership what they have to someone else, they can easily do it unless they are transferring it to any competitor, right? So here in the right of first offer, it is mentioned that investors have to first offer their shares to the promoter. If the promoter then declines, they can easily transfer their shares to any other party unless they are competitors. So the definition of the competitor has to be mentioned in the definitive documents, and that will help the investors understand who they can sell to. So that way we complete section 2 of the entire term sheet, which was around key consideration, and lot of discussions take place on the promoter lock-in, on vesting of the shares, on anti-dilution protection, on the exit mechanism, on ESOPs, on the voting rights information that has to be transferred. So it is a section which will have lot of discussion that takes place between the investor, client, investment bankers. Now we are moving on the section number 3, which is documentation and incidental matters. So this section covers definitive agreements to be executed, condition precedent to closing, the timeline for completion, cost and expense allocation, and regulatory and compliance filings. Now these are mostly, as mentioned, documentation and incidental matters that are not very related to the transaction overall. So it converts the intent into legally binding documents. Up to section 1 and 2, there were a lot of negotiation that could take place. This section, when agreed to, will create legal binding between the documents. It helps understand if section 1 and 2 are agreed to, then what are the things that have to be executed. So definitive documents like share subscription and shareholder agreement for furtherance of the proposed transaction have to be given within 90 days from signing this term sheet, right? So investment bankers and the client have to work upon this share subscription and shareholder agreement and then send it out to investors for getting it signed. Then condition precedent to closing. So some of the conditions that has to be met: complete legal and financial due diligence for satisfaction of the investors, obtaining regulatory permissions. If there is a mergers and acquisition going to take place, then there are a lot of approvals that have to be taken from the regulators. So all those have to be done. Then execution of definitive documentation in form and substance with agreed terms. The final version has to be created. Execution of an employment agreement between company and the promoters in form and substance agreeable to the investors. So if it's a startup and the company and the promoters have not signed the agreement of employment with the company, so that has to be signed. Then company's articles memorandum of association have to be amended. Then no material adverse change shall have occurred in the business. So after having started this discussion, there should be no material changes that should have occurred in the finance business operation model and things that can hamper this transaction down the line. So any other condition that may be present deemed necessary by the investors pursuant to due diligence on the company or otherwise. So to close the transaction, all of these conditions have to be met. After that, standstill provision mentions that from the date that this term sheet was given out to the client, the company shall not get involved into all of these points. So not enter into transaction for acquisition of property business that is material in nature, like big ticket size, conduct the business in ordinary course, incur any substantial indebtedness, so not taking any major debt, then appoint or relieve any senior employee, make change to share capital of the company. So the timeline that is defined, it could be 6 months, 3 months, it could be 6 weeks, 3 weeks, whatever is defined in that period. This all have to be maintained. And representations and warranties. So here this clause mentions that the company represents the investors that a proposed transaction is accordance with applicable law as per the Indian Foreign Exchange Regulation and shall not violate, and the company shall not violate any terms and in respect to corporate and statutory approvals. 3.5 mentions about statutory approvals. If there is anything that has to be done so that the transaction takes place safely, all of those approvals have to be obtained. And in case of event of default, the definitive documentation will set out all of the events of default and consequences, and the impact of all of these is mentioned in the earlier clauses which we saw in section 1 and 2. So all the documentation and incidental matters are taken care in the section 3. The final section that we have is general clauses, and here these clauses ensure legal enforceability. All of things are covered as per governing law and jurisdiction. There is confidentiality, then there is non-binding nature of the term sheet, amendments and waivers, exclusivity and non-shop clauses, which helps the company, the investors, and the investment bankers all stay in legal hygiene that protects all the parties, right? Finally, in general clauses, expenses are also covered, like who is going to incur all the expenses of consultancy, advisory, due diligence. So mostly these are all incurred by the company that is going to get the funding or going to get acquired. So any expenses in addition to basic expense initiated by investors shall be borne by investors. The above expenses are to be covered by company, but apart from that will be covered by investors. Then confidentiality, all the information that is shared between the investors and the company has to be kept confidential. The exclusivity, so company and promoters agree that the following 60 days from now this execution of term sheet by both the party shall be exclusive. So the company will not reach out to any potential investors for the next 60 days, and all the discussion will be taking place between them two only. Then there is clause of termination, that term sheet shall terminate 90 days from execution unless mutually extended by both the parties. If within 90 days a definitive document is not created, then the term sheet that is shared as of now will get terminated and new has to be created. Then there is amendment, so both parties may amend the term sheet by mutual consent in writing. Definitely there will be a lot of amendments that has to be made to reach the definitive documents. So that is mentioned. The governing law and jurisdiction, so the term sheet shall be governed by laws of India. Any dispute arising of the connection with validity of this term sheet or the definitive document shall be subject to exclusive jurisdiction of the courts of so here high courts of Mumbai or high courts of Delhi, whatever court the parties are connected to, that will be mentioned. Or if it's an online court, that is going to be mentioned. That takes care of the section number 4, and that way when this section number 4 is covered, all the parties are then legally in the hygiene place. If things go haywire, then all of the clauses are covered, so people are taken care of. So now how to read a term sheet as an investment banker. So when you are going to work upon a transaction related to fundraising, M&A, then you will receive these kind of documents, and the first focus should be on understanding the economics, the control that is going to be shared. So section number 1 and 2 are going to be very very important. Then you can have an overview of the documentation and legal clauses. You will also have to validate the exit and downside protection. How are those things being mentioned by the investors? Are they only seeing them as a priority, or are they allowing some benefits to the acquirer party or the portfolio company as well? If you find that everything aligns well and both the parties will benefit from this transaction, then you can move ahead and do the definitive documentation and facilitate the transaction. So always read with founder plus investor lens so that both them party mutually agree to things and that your credibility always increases down the line. Understanding term sheet is going to be very, very core for someone who wants to break into venture capital, private equity, or investment banking. And hope that through these two parts, you are now able to understand about it. Please do let us know your recommendation or suggestion about more such video topics that you want us to cover, and we will try our best to get them soon. So that is it for this video. Until then, this is Karan Damania taking your leave.